get all the detail on what's happening in the broader market with our featured guest, Marc Whittaker. He's joining us from Investors Mutual. Marc, good afternoon to you. Look, I will let viewers in. We saw each other on the lift on the way up here.
We did.
Yeah,
I think we've covered up on everything.
Yeah, okay, yeah, tuna. No, I'm kidding. But like honestly, it's been so volatile.
It has.
Like it's not an easy market for anybody to navigate.
It is not easy out there, Nadine, and I think I've said it before, but markets hate uncertainty, and that's the situation we find ourselves in. The world is an uncertain place at the moment, and clearly interest rates are where they top out at is a very open question, and that's really driving markets, it's driving sentiment, and markets are really a function of investor sentiment, aren't they? And that's at the moment that's a highly uncertain and volatile place to be, and we're seeing that. So despite the fact we're up today on the markets and we had a good day yesterday, it's really a bit of yin and yang. Really, we're getting good days and we're getting really bad days, and it's making it quite difficult. But I think the takeaway is things are uncertain, they remain uncertain, and in that world, you've got to think about how best to position your portfolio, how best to invest in those sorts of conditions.
Yeah, well, you've done my job for me, because that's the segue, isn't it? You know, what is most important? Is capital preservation most important? Is income, taking on increased importance?
I did want to talk to you and your viewers about income. So, in particular, when we talk about small caps, people tend to think about the capital gains and how many X multiples I can earn on a particular stock. But I think it's really important to remember that income, it's not just a big cap, large cap story. It's actually plays quite a crucial role in small caps as well. In terms of your total returns, when you think about your portfolios over a long period of time, in fact, dividends do account for probably half of your return on average for your
even
typical,
in small caps?
Yeah, by and large. So I think in that context and thinking about things and the markets that we find ourselves in, the question is, well, how does income play in my thinking at the moment? And I think in these sorts of markets where everything gets sold down, investors are not quite panicking, but they're looking to move capital away from equities, and they're selling anything and everything. The good, the bad, and the ugly tend to get sold off altogether, and we're seeing that at the moment. And I think in that context, we're seeing some really good, high-quality small caps who pay really good, sustainable, enduring, and hopefully growing dividends over time. And these things are trading on very attractive dividend yields. So I think there's a bit of a safety net there for investors. If you can find some of these really good quality names trading on 6, 7, 8% dividend yield, I think that's a really good safety net for investors.
Name one.
I've got 3 I can name for you, Nadine, but I think Here, There and Everywhere is one. So that's the leading radio.
HT&E,
yeah, HT1, Here, There and Everywhere. So that's the leading radio network operator in the country. Southern Cross might argue differently, but certainly HT1 and Southern Cross are up there as the two leading radio operators. Very strong generator of cash. Now, people might argue markets, it's somewhat cyclical. Radio advertising can be a little bit cyclical. We're going to an uncertain time. I think 2 counters to that. One is radio does tend to be far more resilient than other forms of media, particularly free-to-air. So I think that does tend to hold up better because you do get that mass audience reach through radio. I think secondly, they made a recent acquisition of Grant Regional Broadcasting, so there's a lot of synergies that come in on the back of that. So I think the bottom line, the operating earnings for HT1 in the next 1 to 2 years is quite well supported by that. It's trading on 8 times PE. So people might say, Mark, well, it's a small cap. There's a buy strike. There's lots of things trading cheap. It's at an 8% dividend yield, fully franked. Now, I think that's quite an attractive level, entry level for people to think about when they're looking at this stock. The fact it's got those synergy drivers behind it with that acquisition. It's got the leading radio networks in Sydney and Melbourne through KISS and Gold in Melbourne, KISS in Sydney, Gold in Melbourne. I think there's quite a very attractive story there to relate back to people.
And just to be clear, so this is still through a long-term investment thesis?
Absolutely, absolutely. So 8 times, I think this is a stock that longer term can trade easily at 10 to 12 to 13 times earnings. And that dividend yield at 8%, that's a 50% payout ratio as well. So when you think about the margin of safety around the dividend, perhaps earnings fall a little bit as the cycle gets a bit tougher. There's a lot of headroom there to keep that dividend quite high, because you're not paying out all your earnings. It's not like some of these other companies that we see where they're paying out everything and eating into the balance sheet to pay the dividend. There's this cash covered dividends, low payout ratio, low PE multiple, attractive industry, market leading positions. There's a lot to like about that particular stock.
So I know on your list is SG Fleet.
Yes.
SGF is the ticker code. Again, I can't help but think that there are particular market dynamics to where we find ourselves in the cycle that are providing big tailwinds to SG Fleet.
So SG Fleet being the largest fleet manager and one of the largest novated leasing players in the country. So
and there's been a constrained supply.
There has been. So they've benefited on one side because your residual values or your cars that come back into the business from your novated and fleet customers, they've been able to sell it at higher end of lease values because cars have been hard to find, second-hand car values have gone up. That supply is improving. So I think on the one hand that windfall from the residual end of life story will unwind, but on the other side you've got new supply coming in. So the long pipeline of orders on hand waiting to be fulfilled are still there. So I think there's a good 12 to 18 months of forward-looking demand that they can see, which is again quite encouraging. Very strong cash generation. So again, just like HT1,
getting back to that cash
generates
generation,
very good cash. Payout ratio of 60%.
16?
60% payout ratio.
68% payout ratio. Yeah.
Dividend yield of 7.5%.
Okay, 7.5.
Trading on a PE of 8 to 9 times. Again, a very cheap, very high quality industrial in our view. Just trading on what we think are very attractive fundamentals. And in this world, this uncertainty that we find ourselves in, being able to buy an industrial of that quality, the leading fleet manager provider in the country, so number one market position. It is a competitive industry, yes, but they are the market leader. Long-term customer contracts, long-term customer relationships, reasonable barriers to entry, I think, when it comes to its competitive positioning. Again, a lot to like about it. Very cheap, very attractive dividend yield, fully franked dividend yields as well. So these are very attractive positions, entry points, I think, from my point of view, to at least be thinking about. In a world where we have got volatility, we're looking for returns, we're looking for some certainty around our returns. I think those dividend yields speak a lot to investors.
Quantum Intellectual Property, it's on the list as well. You first introduced me to this company, which I've had the pleasure of speaking to the CEO a couple times now since. I didn't sort of consider dividends to be part of the story.
Well, it's on a yield of 6.5%. I think there's a couple of things to like about this one. So it's one of the leading intellectual property attorneys operators in the country. It's also a beneficiary of the currency. So a lot of what they do is priced in US dollars, and their cost base is largely Australian dollars. So we think about where the currency has gone from 74 to 62, 63 cents. There's quite a tailwind there just from the currency. But that's not the main reason why I like it. I think it's in a very stable industry. It grows at probably 4 to 5% top line every year. So nice and stable, predictable and boring. Immune somewhat to the cycle. So if you're a large corporate and you're looking to register your IP, your R&D dollars are going into new product development. You're looking to protect that investment by registering patents and copyrights and so forth. QIP are the guys to provide that service to you. And I think in an environment where the economy is still growing okay, like consumers are still doing okay, corporate balance sheets are very strong, corporates are still reporting quite benign revenue conditions at the very least. I think that R&D continues, and I think that's quite a defensive exposure in the sorts of markets that we're finding ourselves in at the moment. At the same time, they're paying what again is a very good dividend, 6.5% dividend yield. Again, a very low payout ratio, 60%. Trading on 11 times PE, so again, not a very demanding valuation as well. And has a cost out program in front of it, looking to grow its operations in Asia. There's a bit of a growth angle there as well. So I think on all counts, these three stocks stock up pretty well in terms of certainty around the dividend, resilience of the dividend, which I think is important in this market.
Love it. Thank you. Really appreciate it. And just to reiterate, we're talking about HT1, we're talking at SGF, and also QIP.
Yep, that's right.
Thank you. Mark, we'll see you in a couple of weeks maybe, hopefully.